Tesla is melting people's brains. Now, there are many people who watch our videos. One, our diehard community members who I love, who subscribe to our software. Thank you very much. And I still want you to watch this video because it repeats a lot of the things and it's all about repetition. Two, if you are new to this channel, you need to hear this video because I've been preaching this for years, last 2 years on YouTube, but being a YouTube guy does not make me an expert, which is something I really stress. Three, you've kind of listened. It makes sense to you, but it hasn't clicked yet. So let me give the analogy of all analogies that I love. When people get divorced, everybody watching this video has known people get divorced. And in a few small cases, it was one incident. Somebody cheated, somebody did something horrible that caused them to go, what did I do? I'm out immediately. Mm-hmm. But in most cases, what is it really?
A bunch of little things that build up.
Yes.
And then there's an explosion.
And there's an explosion. And then the explosion might be something as simple as, you didn't let my mother come over for dinner. Is that really the reason they got divorced?
No.
No. But that was the final spark that caused the explosion. So how does this relate to Twitter? To Tesla. Twitter is that final spark. Everyone in this world is trying to blame Twitter on Tesla's problems. Tesla's problems aren't Twitter. In fact, Tesla has one problem only: overvaluation. I think the rest of the company is great.
It's working out very well for them. Revenue's growing, cars are getting delivered.
Could they make more cars? Of course they could.
Everybody can make more cars.
Exactly. I don't think it's their fault they're not creating more cars. But everyone wants to blame Twitter as a distraction for Elon. And Elon went on Twitter last night and said, I will honor whatever this poll comes out. Should I step down as Twitter CEO? Guys, it's all BS.
It's really funny Yahoo Finance posted on Instagram the poll and the comments, and I read through them, and all of the comments, majority, were he needs to step away from Twitter and focus on Tesla, and then Tesla will be better. And it's like, really? So if Elon dies, Tesla's screwed.
So,
right?
And by the way,
that's what they're saying.
If Mo is right in saying that, which I think is what he's saying is correct, that if Elon dies, then Tesla's done. Why would you ever invest in a company like that anyhow? You know, one of the things I always told business people who I knew said, my business needs me more than anything. I'm like, well, then you don't really have a business. And it was always a shock because everybody wants to say, like, look at me. I'm this big, bad business person. And if my business doesn't have me, we're done. Well, then what do you have? You can't sell that. If anybody ever came to me and said, the most important part of my business, buy me, I'd say, why would I ever buy you? I would never want you. As Warren Buffett says, we want businesses that an idiot could run because eventually an idiot will run it, right? And for me, in the world of my idiot businesses, I buy on margin of safety. I buy my real estate so relatively inexpensive compared to cash flow. And the reason being is because eventually something's going to happen where I'm going to put the wrong person in charge and I still want to make money during that time. But with Tesla, the issue has nothing to do with Twitter. It's overvaluation. Tesla stock is down because it's overvalued, and when markets start to sink, when the NASDAQ has fallen 30%, the most overvalued stocks will drop the most. If you don't think I'm being consistent, go watch video number 500 of our channel. We've done 2,000 videos.
Yeah.
I've been saying it since day one. And for a while, we looked wrong because markets kept going up. But we kept saying valuation drives everything in the long run. Everything is driven by valuation in the long run. Now, back to our good friend Tesla. So let's sit there and discuss margin of safety. People have done a 180-degree turn on Elon Musk. Have you not noticed that? He went from literally the god of the left community to now he is a villain of the left community. Yeah, like an absolute villain.
I think they went more than 180. I think they started here and then went all the way around and then came all the way back and they just keep going. They're so angry at him, they can't stop.
But this is my point about margin of safety. This has all happened in the last year and a half. And we kept saying to you guys, Tesla could very well end up being the biggest car company in the world. Let them be the biggest car company in the world before you value them as such. And this is exact proof. Anything can happen along the way. When you have a person that runs a company that everybody considers to be a god, it's just a matter of time before he actually thinks he's a god and he can do everything. And that's what he did when he bought Twitter. I have a question for Elon. And by the way, I like Elon.
I love Elon.
What the f*** were you thinking buying Twitter? Why do you even care? Focus on making an amazing car company because that's what you're doing. You are making an amazing car company. They make great cars. They are very profitable. They're growing like crazy and they're changing the world of the automotive business. Do you know how many times in history you can say that somebody has changed the world?
Very, very few.
And Elon could very well wake up in 5 or 10 years, we go back and say, yeah, he changed the world. You can make the argument now that he's changed the world in some fashion. But in a timeline of 20 years of owning a company, just think about this. What has Apple done in the last 20 years? Let's put it this way. 25 years ago, it was almost bankrupt. 25 years ago. And now it's the biggest company in the world. And in that time period, they created the iPod, the iPad, the iPhone, everything having to do with everything in your house. They have Steve Jobs died. Tim Cook, Uncle Tim took over.
Actually, Steve Jobs was fired. Steve Jobs came back.
Well, he came back in 98, but when they almost went bankrupt when he came back.
Right.
Guys, all these things can happen. And you're telling me along the way that you're amazed that a man like Elon Musk went rogue and did something completely crazy? That's the point. We don't know what's going to happen in the future. That's why you need to be conservative on your assumptions. And Tesla's assumptions were not conservative. The investors' assumptions, not Tesla. This is not Tesla's fault. This is not Elon's fault the stock is overvalued.
He knew what he was doing. When he was diluting shares, he knew exactly what he was doing.
When Mo says he was diluting shares, what he was saying was, hey, you guys think this thing is worth this much money? I'll just keep issuing shares and getting my money that way. But when you look at valuation and you look what it takes to justify the valuation of a company and you look at Tesla, it is massively disconnected. Now you can sit there and blame all day long what you want. And what I'm saying to you makes sense, keep listening. It's just like the relationship analogy. You don't divorce your spouse because they left the orange juice on the counter overnight. You divorce them because they stopped. They're like, I'm done with it. I'm done with them not listening to me. It's over. Now, is that an extreme? Maybe it is, but do it every single day for 20 years and maybe it's not. But he went and bought Twitter. Why would he buy Twitter?
So I don't know, outside of just
ego
pounding his chest.
Yes.
I do find this funny. And I read this in 3 articles this morning, one from Dan Ives of Wedbush. People are saying that if he steps down from Twitter, then he'll have more focus on Tesla. Okay, that's fine. But the cash situation that he needs to keep selling to get, that doesn't change.
So here's why I think he bought Twitter. And if I'm to be honest, what I'm thinking. If I understand valuation, here's what I'm thinking. Okay. I'm looking at going, all right, I have $300 billion in Twitter in Tesla stock. Not anymore. Let's call it $150 billion. Okay. If I believe in valuations, maybe I believe my real shares are actually worth $30 billion. So I have $120 billion in garbage valuation. Right. Let me sell $40 billion of that and buy Twitter. In my opinion, I basically sold my $30 billion of Tesla stock and I got Twitter for free. I would buy overvalued assets with my overvalued stock. I would buy, listen guys, 3 days after he took over Twitter or something like that, he said, bankruptcy's in the cards. I'm like, you literally just borrowed all this money from bankers and now you're like, yeah, bankruptcy in the cards. Now, maybe he was saying, your point might be like, well, Paul, he was trying to scare people. Is that the kind of person you want running your company?
Yeah, exactly.
Guys, Tesla's got a lot of work to do, but it's doing a great job. It is a company that's starting to generate a lot of cash flow and it's worth something. I can finally see everything they're going, okay, they're starting to make the money. I can see this path to much higher values, but it's still hard to justify today's values. What values are those? We're going to pull it up in Stock Analyzer tool and run the numbers on a low, middle, and high estimates for the future. But please do me a favor. Do not blame Tesla's stock woes on Twitter. Yes, the stock is down a lot since he bought Twitter, and it's a good excuse. But that's just like saying overvaluation is the spark, and in a room of gasoline, the fireplace in the corner will eventually cause an explosion. We just don't know what spark it'll be. In this situation, it might have been Twitter as the start of the spark. So Mo has it up on his screen. I'm going to pull up Tesla.
Wild ride this stock has been.
It's pretty even. By the way, last night I texted Mo and my brother. I said, if this survey goes through and he steps down, the stock's going to spike. And it spiked early morning, then fell. Yep, now it's 6%. Even. Okay. He hasn't officially stepped down yet, though. But look at it. This year so far, it's down 62%. Okay. So let's go to analyst estimates first and see what analysts are thinking. Listen to this. Look at this, guys. They're not even. I mean, it's not like they're calling for 10 times profit. Is it growing? Yeah, but 2.5 times, 2.8 times revenue growth. All right, not even tripling. And by the way, for those of you who don't believe Tesla's a car company, 87.7% of 2021 revenue came from cars. 87.7. So.
And on AI Day,
yeah,
when they were, the robot,
yeah,
he was like, we need to start getting this robot out there so people see us as not a car company, or less of a car company, I should say. So he did say they're a car company.
All right, so let's go to Stock Analyzer tool. Mo, do you want to do the 10-year or the 20-year?
I'll do the 10-year.
Okay, great. I want to do the 20-year anyhow.
Okay.
So Mo's going to do a 10-year analysis. I'm going to do a 20-year analysis on our stock analyzer tool.
So I'm going to do a low and mid, and then my high is going to be ridiculous.
Well, I still want your high to be ridiculous, but on a
Reasonable.
Okay, it could hit that.
It could hit it. Reasonable.
Okay.
Okay.
So my assumption on 20 years is going to be number one car manufacturer in the world. Right now it's Toyota doing 15. So I'm going to sit there and do some numbers back of the napkin to see where it stands at, to see what would have to happen. So currently, let's assume. Dun, 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 dun. All right. Okay, profit margin. Yeah, it's a tough one, isn't it?
Yeah. On my high side return, I don't think I'm going to go with the traditional high side return, because I kind of want to do the high side from a perspective of not me putting mine in, but somebody of Tesla fandom putting theirs.
Okay. And I want to explain my revenue growth numbers. So while you're doing that, I'm going to explain mine. Okay. So guys, you might sit there and say 15% revenue growth isn't a lot for 20 years, but let me explain to you how I did it. I took the average car today of $40,000 a year, brand new. Now theirs is higher, but for them to get bigger and bigger and bigger, they have to grow much more. Yep. They have to decrease their average price.
Come down.
I assumed 4% growth in the average price of a car for the next 20 years, and I assumed them selling 15 million cars a year in the next 20 years. And I got to 15%, 14.2% growth rate needed to get there. So I'm going to 15%. That's very, very difficult, but possible. Low side, I did 5% a year, which is, I think, very low. And middle, I did 10%. Profit margin, I do think they'll have above average profit margin as long as they stay away from the unions, 6, 10, and 14. This actually might be low on the high side. Actually, let's go a little bit higher. Why are you laughing, Tim?
The unions?
Well, no, because it's true. I mean, unions, if we have unions getting involved in this thing, and for those of you who hate that comment, I'm sorry, but if you look at car manufacturers now, their cost to manufacture a car in the U.S. is insanely high. And how do you direct that to? Right to labor costs.
Yeah.
That's it. It's just tough. Listen. When I was in 2003, I worked in Toledo at an automotive dealership, and there were literally custodians at the Jeep plant making $100,000 a year. More power to them. But you can't tell me you can build a cost-effective car when in 2003, 19 years ago, with overtime, they're making $100,000 a year to sweep the floors. I'm sorry, you just can't do that. So I did 5, 10, 15. Profit margin, I did 8, 13, 18. Same with free cash flow. PE, I did 15, 18, 21. Now, you might sit there and say, Paul, that's crazy. Well, remember, this PE right here was like 200 to 300 at one point. So it's already down from its high, and the larger and larger a company gets, the less growth potential it has, you have to assign a lower PE to it. And for my returns, I did 12, 15, 18. Because I think this is so difficult, but possible still. I still want 18% return. Let's hear yours.
So I did 8, 12, and 20.
Okay.
5, 7, and 15 for profit margin.
You really jumped those.
I did. On the high side.
Okay.
I jumped them. Free cash flow margin, 5, 7, 15. PE, 6, I'm sorry, you're saying 14, 16, 18. 16, 18, 25. Same for price to free cash flow, desired annual term, 12, 14, and then back to 12.
So guys, remember, Mo is hit your analyze button.
See?
All right.
These make sense.
So on the low side, you have what?
Low side, I have about $21. Middle ground, about $37. And high side, $210.
So if you believe all those high options, high assumptions, 20% growth rate, 15% profit margin, all the way down, 25 PE in price of free cash flow. Guys, a company that large should not have that kind of PE multiple.
And I will say, a lot of these analysts out there that I'm seeing, they have price targets around $200, $210.
Okay.
So it's not far off.
Now, let me hit the analyze button on mine. Look, I have a low of 26, a high of 108, and a mid price of 60. So what this means, guys, is me showing you that $40,000 average price today, equating out to 4% growth over the next 20 years, which is about a $90,000, $100,000 average car in the future. With those kind of profit margins and this multiple and this return, we're still not even there yet.
Yeah.
And guess what? I keep saying it seems around 50 or 60 bucks to stock. Every time I run the numbers, that ends up being my number right there. Yep. So remember, in the next 20 years, other things are going to happen at Tesla. There are going to be other things that happen. That's why you need that margin of safety. That's why you need to wait until the price is much lower than when an idiot is going to run it, because somebody will eventually run it. In this situation, this is not enough. So what would have to justify the price today to get 12% return on your money? Well, let's go do the top side. Let's go to the middle side. 20, 20, 20, 12% return. All right. So if you go 20% a year that was for 20 years. Let's go 12%. All right. It's about there.
Yeah.
12% revenue growth for 20 years, 20% profit margin, bottom line after taxes, which they haven't had yet.
You don't really see that in the car industry.
Well, you haven't. Ferrari does. But by the way, Ferrari has a 50% gross margin. And they have bottom line about 18%.
Ferrari also sells 9,000 cars a year.
And that's my point. So for Tesla, in order to get to the level it needs to get to have this kind of volume, they have to decrease their margin.
Right.
It's just not possible. So guys, if this makes a lot of sense to you, subscribe to the channel. If this makes sense to you, but you still have questions, watch more videos. And if you absolutely hate my guts and you think I'm a Tesla hater, just remember, Mo and I have puts on Tesla at lower prices because we divide the company from the stock price. We evaluate them differently and we're waiting for the price to fall. Thank you very much for your time.